Welcome to the R.E.I. Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the R.E.I. Diamond Show with Matt Faircloth on finding, funding, and executing real estate investment projects. I'm Dan Breslin, host of the R.E.I. Diamond Show, and each week I invite another high-caliber performer to share their unique experience as it relates to real estate investing. This week's guest is Matt Faircloth of the DeRosa Group. Matt founded the DeRosa Group in 2005 and has since grown the company to include property managers, construction managers, and a specialized construction labor force. Matt has raised and deployed more than $8 million in capital into real estate investment projects ranging from single-family fix and flips, buy and holds, to apartment buildings, and even includes a 10,000 square foot office building which now operates as a small business center. This episode will include discussion on topics ranging from raising money, buying apartment buildings, property management, and building an effective team to execute real estate investment projects. Because I've recently ramped up my own buying and rehabbing, I'm excited for this episode. I'm here with my pen and pad ready to take notes on Matt's methods for structuring his business, attracting and qualifying his contractor and management resources, and of course, selecting his private lenders. Without further ado, welcome to the show, Matt.
Thank you so much, Dan. It's an honor to be here.
All right. So give us a little bit of background, how you got started, what it was like in the early days, and then give us just a Reader's Digest version of what your business and activities look like, say, over the past 12 to 18 months, Matt.
Sure. Okay. So I actually got started in 2002. I was a sales rep working for a company called Ingersoll Rand, and I was just selling their machinery and things that went into factories. I was one of their traveling sales reps. Good job, just not something that was really satisfying or, made me happy per se or fulfilled me, but it was a good job. I was came to be my wife at the time, and she introduced me to the Rich Dad Poor Dad technology and to all the Robert Kiyosaki books and to the board game Cash Flow. And immediately I was hooked when I played the game Cash Flow and started playing once every other week, reading a lot of just about every book that he had out at the time in 2002. Bought a single family home in 2003 that I moved into, and it was a 3-bedroom, 1-bath. And had two of my friends move in with me. They were paying each guy was paying me $500 a month, and the mortgage was $940 a month. So I was making $60 a month and living there for free. And for 25, 26-year-old at the time, I thought I was just absolutely slaying it, and we then expanded from there and started buying, my girlfriend, now wife, started buying a few rental properties around Philadelphia. Started out for our investments with a $30,000 loan from a family member and bought a duplex and fixed it up, and it just took it from there. That was our seed capital, and we've then turned it into what you described at the intro, which thank you for that. And where we are now, let's see, you asked where we've been in the last 12 to 18 months. We've done fix and flips. We've got a pretty sizable rental portfolio around Mercer County, New Jersey, Trenton, Hamilton, Ewing. We have an apartment complex in Northeast Philadelphia, and we're aggressively looking to expand into mid-size multi to buy more properties like that because we're very happy with the performance we're getting for the multis that we do own. I guess we can get more into this, but we're funded through private investors that come in and want to make a return on their money, but don't want to do the doing of operating the real estate. And there's a lot of people that want to do that, and so we've been able to locate them and pull them in through private placement partnerships into small and large real estate investments. It's been fantastic. It's been something that's been very rewarding for us and them, and we're looking to do more and more of that as we move forward.
Nice. So let's start with basic 101 stuff. The single family fix and flips, the single family landlord. And I know this is not necessarily the focus of where you're at now, but if there's somebody on the line listening and they've got, 1, 2, 3, 5 rentals, something like that, what would you say were some of the most critical turning points or leverage areas where you've really gained, maybe a step up to the next level? Did you have any decision points or implementing certain processes? And I know that may be separate from the fix and flip, and that might be one thing, or maybe in the single family portfolio as you kind of grew to the next level?
Mm-hmm. Well, here's the thing. We still do the smaller deals. I'm just really way more selective. I mean, I put a duplex under contract last week. So it does, like I said, we're way, way more picky, and and for where we're at right now, I start reading the tea leaves on where economies are going in certain areas, and so there happens to be some very, very large projects happening in one of our investment areas, and I'm just trying to get around those projects, so some of the spillover from these multi-million-dollar projects affect a duplex that I happen to own right across the street. That kind of thing. So that's some of the strategic stuff that we do on the single families and small multis. But to answer your question, the desire to step it up, we did step up over time and got into, went from a single family home to duplex to here to there. Once we felt like we had the procedures down that they could be scaled, such as lease contracts and relationships with contractors and attorneys and realtors and that could help us expand into the larger echelon. So we built our relationships and stretched ourselves as we went, but I think it's one of those things where once you feel like you perhaps haven't mastered the original, you can't say, okay, I've mastered single family homes and now I can go to duplexes or now I can go to 4 units or something like that. You do need to stretch and grow and learn a bit and just push up a little further and learn things that can get brought into those larger conversations. We also, we can talk about this too. I grew too fast at one point. We bought a couple of small multis, 4 families, a bunch of single family homes, and then we bought a 10,000 square foot office building, which had nothing to do with all the single family homes that we had bought. And that was an enormous learning curve. And it didn't work out too well for the first couple of years. We were able to turn it around and it's now profitable, but it was one of those periods where we got ahead of ourselves because nothing transferred. The leases are different. The marketing for an office building is different. The maintenance for an office building is different. What you're allowed to charge tenants are different. Everything's different. So that's an example of how we stretched beyond our capacity and weren't able to carry things we had learned into the new conversation and had to learn all over again.
That's a great point and a real honest evaluation I'm not sure a lot of people are capable of making. So let's talk about that challenge you faced with that building. Can you give us the details and how you overcame that, turned around,
Sure.
Made that deal profitable, Matt?
Yeah, sure. My greatest lessons have been from my mistakes, and so I think that if you're out there and you're not willing to own up to your mistakes, you're really missing out on some really great learnings. And so I'm happy to tell you all about the mistakes that I made in my business. That being one, buying this, sitting here in the building, buying this building at that point in our investing career was definitely one of them. But it's good. We turned to, we did make lemonade out of the lemons. But the way that it went down was we bought a 10,000 square foot building, bought it for $52 a foot, which, quick math, $525,000. The market at the time when we bought the building was 2007, I believe 2007, 2008 when we bought the building. The market at the time was renting for $15 a square foot with utilities on top of that. This is, if you remember back 2007, 2008, that's when everybody thought everything was great, right? The beginning of 2008. Oh, yeah. We're all going to the moon. Right. By the time we had closed on the building, conversations were really starting to change. And we had a short-term tenant move in, which okay, it's great. It's a guy came in, he leased out the office building from us. We're good to go. By the time he moved out, it was a school that was leasing the building, and they leased it, and it was like a VOTEC school. So they were in here for, 6 months. That gave us just enough time for the economy to just absolutely just have the bottom drop out of the real estate market, right? By the time they moved out, we were in a very, very different economy, and there was nobody out there looking for a 10,000 square foot building, looking to pay you $15 a square foot. By the way, I'll real quick, $15 a square foot is just this dollars per square foot stuff is commercial real estate language, and the way it breaks down is that $15 is you get that per square foot for your building per year. Okay, so $15 a foot on a 10,000 square foot building would be $150,000 a year in rent, not per month. So just for your listeners out there that don't have much exposure to commercial, not when we bought this building, when I very, very first heard people quoting dollars per square foot, I'm like, because the residential language is per month, right? That everybody talks about. Nobody talks about what you get a year in residential real estate. Yeah. But in commercial, the conversation is how much you get per year. Okay, so that was the annual rent. Now, I promise you, we didn't make that error. I'm not saying like we're going to get $150,000 a month for this building. No. We weren't that silly, but we did look at it and say, okay, we're going to get a third of our price back, give or take, per year in rent. Where that's pretty good. I mean, you buy a single family home for $30,000. If you're getting $10,000 back a year in rent, that's pretty good. Right? You know, you're getting a third of your purchase price back a year, you know, hey, I'll take that deal.
Oh, yeah.
Where for this building, we did the math, and we're like, hey, that's great, we'll take it. But then just the economy shifted. Nobody was looking for that for this size of real estate, even in downtown Trenton where we were with all the state offices and everything like that. I think there was a change in governorship, and when Chris Christie came in and just started cutting everything back, I believe. And maybe get my history wrong there, but the state wasn't looking for anything at that point either. So we had to take the building and change it up to a small business center. And so now, like the success story is now we have 18 companies that occupy this building that are all actually paying individually a lot more than $15 a square foot. But it took some construction to delineate the building into little segments to where, this company that occupies 4,000 square foot can have a home. And this company over here that was the work from home guy, like the guy working from his guest bedroom and having his face-to-face meetings in Starbucks, I can pull him out of that scenario and bring him into an affordable situation in an office building and give him a conference room, give him a mailbox, and give him that professional look and feel. So that was our strategy, and we had to be very careful how we cut the building up and start pushing in 2009 when everybody thought the real estate world was about to end. It was about to end, right? Like we thought we were in like the real estate apocalypse. So, right?
I remember.
So right. So it took us several years to lease the building out. The building operated at a loss for years until we got it fully leased and got more and more tenants in to where it started getting into the black. They had to make more and more investments in it, but now it's a great asset for us. We're very, very happy with it, but it took a while for us to get very, very happy with it. So that's the story of this building. The lessons learned is always consider worst case scenario, which we didn't think about. We thought, we'll buy it and we'll lease it. It'll be great. We'll make lots of money. We didn't think about, what if you got to hold it for 3-4 years? Not even that, even a year or two with no rent coming in. What would that look like? On a building that has a $25,000 a year tax bill, that's something you have to think about. Well, how bad's that gonna sting? So that's something that I think is a lesson learned is getting in too big, too quick, and not considering the worst case scenario on a property. Now, the biggest lesson that I tell this to any, if I'm teaching a seminar or something like that, the biggest thing is not giving up. We probably, I guess the thought crossed my wife and my mind to give the property back to the bank at some point, but we decided not to do that. We kept making our monthly payments and taking other properties and maintaining the building with it, the cash flow from other assets we had, and keeping the building afloat and not quitting, not giving up. So the biggest lesson is even when times are tough, don't give up, because things always change. Times always, things get better even when it seems like there's not a real exit in sight. So that's and so now it's this building has turned me into a very, very tenacious real estate investor where just quit is not in mine and my wife's vocabulary because of this building. So I can thank it for that. So.
Nice. Well said. And you answered one of the next questions I had about that and was, hey, were you going to go do this corporate office complex, this small business center on the way in? But you said that you were not going to do that. I personally had a deal under contract in 2009, and it was a 7,500 square foot office building. And my plan going in was to turn it into one of these small business centers and the construction, and I'm like running it around to the private investors I was dealing with at the time. Nobody really wanted to pull the trigger. I guess they had been reading the tea leaves a little closer than I was and a little less risk or a little more risk averse than I was at the time. I guess maybe I dodged a bullet and didn't have to go through that same strenuous exercise and learning the lesson never to give up on that one, because I ended up signing it to another guy. The guy never even moved into the property. He ended up just, kind of walking away after a few years. So office in my opinion, maybe you'd have an opinion on this too, having been an owner, but office, in my opinion, is a little bit dangerous of a segment, I guess, because I don't understand it, because the things don't transfer over. Maybe there's people who can win in that space. Obviously there are. But, with the advent of the internet and the change in, the downsizing of corporate headquarters. So a corporate headquarters used to combine, a 5,000 or 4,000 employee company, and they would have, 90% of the workers working in one location. Well, now they might move to corporate headquarters and they're occupying one floor, an 8,000 square foot office space with 70 executives in there. So just the transformation of the business world partially as a result of the internet, has always had me trigger shy, gun shy, to even look at any more office deals after my first experience. I mean, do you have any take on office as a segment? Would you go back into that deal again today, knowing what you know now, Matt?
Well, certainly, it's an interesting conversation. My short answer to your question is probably, there's not enough wild horses that could drag me to get back into office space at this point because I enjoy residential real estate too much. I've found residential real estate to be more rewarding over time, and I hate to use the word easy, but I figured out the space of residential real estate pretty well. And so we as a company have gotten very, very good at residential real estate. Here's why. I think just to get a deeper cut to your question, so the other, never say never, right? But I view office, and also let's throw retail in there too, into those conversations. I view office and retail real estate. When I say retail, I'm talking about strip centers, not mixed use buildings, which we can talk about in a moment if you want. But I view office and strip centers to be kind of like they can come and go, but if you get the right tenants, you can slay it with buildings like that. But they are a huge risk. The reason I say you can slay it, retail tenants, typically all my retail tenants that I have, and I own several mixed use buildings, they all want to sign at least a 3-year lease, and sometimes 5 with an option. It's something called a 5 and 5, which is an option to renew for a second 5 years. You buy a strip center, which I don't own, but they're intriguing. But again, for what I'm going to say, I probably wouldn't do it. Either it's feast or famine in office and retail, because if you get great tenants that are solid established companies, they will stay there forever because it becomes known that their law firm or their coffee shop or their mortgage brokerage or whatever it is, if they are successful, even like a hair salon or something like that, if those folks are successful, in their business and they're solid operators, they can't move because their clientele learns where they are, right? People that physically go there to that space, like I talked to a hair salon operator that owns one down the street from my office, and she was like, I cannot move. She's like, just my client, unless they're her landlord triples her rent or something like that, she can't leave because her clientele knows where she is. She's been there like 5 years. She'd lose all her clientele, have to start over again. Who wants to do that, right? So you can't beat that. But if you don't have that, you can be in a very, very bad situation where you end up where we are. We got to carry the space. And when I say carry the space, I mean financially, the owner has to kick in with a contribution on maintenance and utilities and that kind of thing. But if you're fully leased with solid tenants, you get to, if you're smart, you get to pass a lot of those expenses on to your tenants. We have 1 electric meter, 1 gas meter in our building and 18 tenants, but they get a bill back for utilities. They have to pay a contribution called CAM, C-A-M, Common Area Maintenance. Even if you have a single boiler on an apartment building, like we have an 18-unit in Philadelphia, I'd love to be able to bill my tenants back for the common area maintenance of that building, but it's expected that, right, it'd be great. Yeah, here's a bill. Here's your kick-in for that, right?
Yeah, not a chance.
No, not so much. I don't think they're going to pay that bill. You could sub-meter, but that's a challenge too. But there's no way you can bill back just because it's not what's accepted in that space on the residential side. But on commercial and on retail, you can do that, And so if you get a good building that has, tenants in it, and they have to pay a premium, but it's going to be a nice solid investment. I tend to like buying dilapidated or distressed residential real estate, putting construction into the place, getting some built-in equity and making more money long term, where retail and office, it's either a dog or it's not, because if you buy a retail pad site that has Starbucks leasing it for 15 years, I promise you're going to pay quite a pretty penny for that site. It's not going to be a nice spread on that deal, but it's a nice stable investment.
So let's switch gears just a little bit. You mentioned buying distressed residential properties, and we all love residential for a couple of reasons. They're liquid. Everybody needs a place to live, so they are short-term leases, but they're understandable even by the common, any person who has to rent a property understands enough about residential, and it makes it that much more liquid, whereas these unique office spaces and retail spaces have characteristics such as, being able to turn in off the breakfast corner to have a Starbucks on that corner. Does everybody, in traffic go into that lot? Is it easily accessible? There's so many other characteristics to come into play that could make a piece of commercial office space or retail strip center unsuccessful that may not be understood by us who are in residential.
You don't think about it. Yeah.
Understand things. Yeah.
I'll give you an example. We bought our office building, and we didn't think about it, but there wasn't parking for a 10,000 square foot office building.
Oh, man.
Now you look at it like, parking would have been nice. But we figured it out. We park across the street. There's a church across the street from my office, and me and my tenants go and volunteer for the church an hour a month and help them bag food to feed the needy, So it's a win-win. We get to contribute, be a part of the community. We've got to meet lots of great people by, other people that are looking to volunteer, and we're supporting the local, the local needy and everything like that. So, hey, it's a win, and we get parking out of the gig. So it's a win-win. But that's only through being resourceful and negotiating local relationships that we're able to score that. But like you said, little things like that, the office tenants become fickle, where I own residential properties where there's not parking like right there next to the place or anything like that. And tenants figure it out. If they want to be in the area, their needs are way more elastic, meaning like they'll stretch to be in that neighborhood if their mom lives 2 blocks away or something like that. And they'll deal with not having a parking or central air or whatever it is. So I find residential tenants to be way more accommodating to things and not as needy of amenities.
Cool. So we're buying these distressed properties. We're putting construction in. Can you talk about maybe a few of the lessons or maybe give us a few of the shortcuts you've developed or identified as a result of building the team? And maybe you could talk about what your team looks like today and how it got to that point. Maybe 2 questions there at once.
Sure. We're actually shifting things up. We still have several employees that do a lot of our day-to-day stuff in the field. I have found a lot of success having, my guy that does my handyman work, like my rentals that need regular check-ins, preventative maintenance, or emergency maintenance, like a lock not working, toilet won't flush, whatever it may be, just day-to-day stuff that happens at a residential rental property. My maintenance guy has been phenomenal, and I found that having an employee versus subbing that out is night and day what you want to do if you have a large enough portfolio. Speaking this to your listeners, that if you got a guy that's got 2 to 3 rentals, obviously you don't need a full-time guy. But I would find a guy that is knowledgeable enough that maybe they might have to pay him $40, $50 an hour to go and maintain their rentals, but he's willing to do it at that rate. So more of like a handyman versus a specialist. We ended up hiring a guy and we pay him, less than $40 to $50 an hour for doing what he does because he's getting 40 hours a week from us. So that employee side, I also have office staff that work for me too that are doing what they do 40 hours a week. The construction labor stuff has been hit or miss. We're going to be moving more to using subcontractors for the field work because I have found that, we used to have 6 employees working construction for us, and that worked out well sometimes. And I find that, things like renting an apartment or, doing a fix and flip or something like that, it's very easy to change gears, very easy to say, we're going to take this wall down. I'm going to let's not put that bathroom over there where we were going to put it. You can kind of go as you just projects change. If for anybody that's flipped a house, about halfway through you end up changing your mind on something, where a contractor will hit you with this lovely thing called a change order. I'm like, oh well, you didn't tell me you were going to take that wall down, or you didn't tell me that the bathroom was going to go over there, whatever it is. So they're going to want to get extra dollars out of you for that. Where I found for having labor, it's a great benefit to have labor to just say, you know what, John, we're not going to do this, we're going to do that. Very simple. They're not going to charge you extra more per hour because you're giving them something different to do, right? Whereas the downside of having labor is you have lulls in business. Unless you're just an absolute juggernaut of projects and you have this enormous pipeline of work for folks to do, we ran into times where we found there was nothing for them to do. Like a week or 2 or something like that where, this flip just finished, this apartment hasn't vacated yet. We were putting them on other people's projects just to keep them moving and stuff like that. And we were having to front their labor costs because they can't, they're not going to, not want to get paid for a week or 2 while you wait for the next project to come along and that. So I found that it was too hard to maintain regular labor on construction. And so we're moving more towards just specialists and GCs and things like that. And just, I'll work with them on the change order stuff. And I've got an employee or 2 that I can use if I need to on minor stuff on the construction side. So that's the equation I've found works. And I've tried a few different ones, but for right now, that's what's working for us. We may grow to the point where we've got such an enormous pipeline that it just makes sense to have full-time guys. But I probably would go for specialized labor if I did that, for guys that are really good at a few specific things.
That's a great observation, Matt. I'm curious as to what right now is in the pipeline, maybe just the last 6 months, so we can get an idea of like how many deals are cooking and what it takes to accomplish that.
Sure. Well, yeah, this is an interesting conversation. I got two things that are interesting conversations, so let's have those. I got one that's we're doing a fix and flip on a 7,000 square foot, 6 bedroom, 6.5 bath. You don't use the word mansion because that just sounds like, it sounds too cocky, and that's not me. I'm not going to I'm sick of rehabbing this mansion. No, it's just a really, really big house. So,
nice.
It's just an enormous property in Pennsylvania, down in the Langhorne, Feasterville, Trevose area, if your listeners know where that is. So, we bought that through relationship, off the market, obviously not an MLS deal because that would have been crazy pricing if that was an MLS deal. We bought it through an attorney lead that we had. That's a, guy that I've known for years, knows that we do real estate deals, knows I can put stuff together that I actually will close and not just talk about how I'm going to close, that we can, get to the table and actually produce money and buy things. We built that reputation with him. We had done another deal. He brought me a deal and said, listen, this has to close in 2 weeks. This property's like literally about a step away from the courthouse steps to go to a sheriff's sale. And so we swooped in the next day. I went down there and looked at the property, saw the possibility, saw that he was selling it for literally 50 cents on the dollar, and put the deal together, put the money together. Purchase price was way, way more than I wanted to use hard money on. So, because hard money, even private lending, I'll give you the numbers. We bought the property all in with closing costs and everything. It was $475,000. So, you figure what private money, hard money is going to cost you on that. We did the math, and it was I couldn't bring myself to it to pay that kind of money. So we ended up going with a bank, believe it or not. But we had to bring a lot of equity to the table too. So I had to bring in a couple of partners that partnered with us on the deal and helped throw in some of the equity and also are working on the job site. So I've got a three-way partnership. Me and two other real estate investors got together and did this deal. One of them had a banking relationship that would fund fix and flips. So they came in and gave us a 70% loan to value acquisition loan and then 100% of construction. So it was a great deal. And me and these three guys all threw a couple of shekels into the pot and were able to close. And then we started, we had to front a bunch of construction and started getting reimbursements through construction draws. The property's worth probably between $850 and $875 fixed up. Do the math, we'll probably invest around $110, $125 in construction plus carrying costs. So it's a great opportunity. And what I learned out of that one, I still learn. I've been doing this for over 10 years, but I still learn every day. What I learned out of that one is I'm not going to pass on a good deal just because I have to bring in other people. So dilution is okay, meaning bringing in other guys to get diluted and to, throw some of their equity in and take a chunk of the project too is fine, because if I didn't do that, I would not have been able to do the deal. My money's in other things and that kind of stuff. And so I didn't want to push all in and just put it all into this project. So it also helped to spread the risk around, to be honest. And also to bring in other guys that had resources and had contracting relationships and also had their own crews that they could put into this house. It's been a great deal. So that's the first thing that I learned. And the second thing that this deal just validated was that if you say you're going to close, you better be ready to close, and you better be ready to get to the table and do what you say you're going to do, because people learn quick that if you are a talker in this business and not a doer, people can smell that on you over time, and I think that it pays to, if you see something that's a good deal, then just do it and figure it out. And you'll get that reputation that you make deals happen. And when you make deals happen, more deals show up because you get known as a guy that actually is going to close and not just somebody who's going to come in and kick the tires for a week and then find a reason why you're not going to do the deal. So those are my lessons that I got out of this one. We haven't sold it yet, so wish me luck. We're about halfway done that project. And if I can briefly, I have a YouTube page. Just look up Matt Faircloth on YouTube. There's or on Bigger Pockets as well. There's a video of the house from me standing outside, so you can see the gargantuan size of this place.
I'll include that in the show notes at the bottom of the page with the link. I'll search that and make sure I include it.
Oh, great. Thank you.
Can I be the devil's advocate on this real quick?
Please. Please do.
What's your feeling with the interest rates rising and you owning a property that's got a retail at $850,000 right now?
Well, okay. I don't think, this is like, I'm far from having a crystal ball or anything like that, but there are other homes for sale in that neighborhood that have sold for more. That marketplace is a phenomenal school system. So 850 is not like this, oh my God, he's going to get 850 for the place. There's other people getting 850 and that have sold for 850 in that area. I have not seen a huge bump in interest rates on the residential side yet. I think that it's on the way, but we haven't seen it yet. I looked at 2 commitment letters for 2 fix and flips that we have, and they're still sub 4 is what people are getting rate locks at, even after the Fed raised the rates. That being said, I think that rates are going to continue to rise. I think that we need to be careful, we as in you and me and other folks that are listening as real estate investors, on and just continue to just really watch this market really, really closely. I don't think that we're due for another crash. I think that things may slow down a bit with rates increasing, but also we're in an election year, so the Fed's not going to, jack rates by right. No, we might see another quarter point or a half a point, but I think that's it until after the presidential election. But I don't foresee a problem. But I did do the math on it, and I did look at other properties in the area. This property, like I said, is in PA. If it was in Jersey, where I live, the taxes on this enormous house are, they're like what? I think $10,000 a year, which sounds like a lot.
Wow.
For if you have listened, right? I know, and you're saying wow because that's low. No, if you have listeners
who are
listening to you from Tennessee or something like that, they're like, oh my God, 10,000. Well, I can tell you, that's not that much money. If you're from the Philadelphia or New Jersey area, that sounds like, wow, that's a great deal for a 7,000 square foot house. So that's the other thing we have going for us is really, really low real estate taxes, which, as you know, from being in the business, that is able to increase your purchase price because everything goes back to monthly payment. Nobody's buying a house free and clear these days for their residents. They're putting a mortgage on it. So if the real estate taxes are lower, then you can afford a bigger monthly payment because people are actually buying on what the monthly payment's going to cost them. And if taxes are lower, there's less tax to pay on a monthly basis. So that's why I'm not afraid on this house. But I am worried about it on the long run. It's something I do lose a little bit of sleep over about what rates are going to do in the next year or two.
The point of the question, which your answer has displayed perfectly, is that you thought about that on the way in. Am I correct?
Yep. Sure. You got to consider all factors in this business. But I also find that there's a difference in considering all factors and then taking action and getting stuck and paralysis by analysis. So I think that it pays to consider all factors on something. We could sell this house for a lot less than $850 and still make money. So that obviously is probably my biggest reasoning why it's like, we're going to be okay. We could sell it in the low 7s or even in the high 6s and get out if we needed to, but I don't think that's going to happen. I think that we're going to get close to asking on this thing, if not at asking or above. So, but there is a difference in getting stuck and having fear step in and saying like, wow, what if rates, interest rates double and people don't want to buy my house and that kind of thing. I think that you mitigate it. You work around it, those kinds of things. I tend to consider all factors and then take action based on the data.
Yeah, and to your point with the low taxes, I'm sitting in Chicago. I do business in Philadelphia, Chicago, and Tampa, Florida, and I'm familiar with the tax structures out here in Chicago and Cook County, Will County, all the counties out here, and Philadelphia. And I know that Langhorne is low for that amount, whereas you get into the city of Chicago has high taxes, just like counties surrounding the Philadelphia area. City of Philadelphia taxes are relatively low as a result of the city wage tax, but the city wage tax then plays into people's decisions and ability to afford more house as well. But, Jersey,
sure,
Chicago, Delaware County, we're talking about high taxes, across the board. So that's definitely something that would make that deal a little more safe. Let's shift gears again and let's talk about, the transition from single family rental properties to when you identify the apartment buildings and kind of what the apartment building component of your business looks like today and how it got there.
Sure. I've always been a multifamily guy. Our second investment was a duplex. I enjoy the stability of multifamily in our business because it is very hard to put a multifamily completely. If you buy it right, if you buy it at the right price, and if you budget properly for expenses and income, then it's very hard for a multifamily to long-term be a loss. right? Single family home, on the other hand, I've written about this and spoke to others about this and everything like that, that there is no better investment than a single family home with a long-term tenant that is paying their rent on time, and paying market rents, right? The reason for that is a single family home tenant will treat it like a home. They will shovel the snow. They will cut their grass. They will, decorate the place for Christmas and everything like that. And most importantly, they will pay the majority of the utilities, including the water bill, if you structure it properly. That being said, once that tenant moves out, you will end up paying, I have found, quite a bit more in unit turnover, and a single family home either makes money or it doesn't. You're either vacant or you're not. So I have found that single family homes are a good addition to a portfolio, but I don't think that they should be the only thing in a portfolio, because if the tenant moves out, you got to pay the mortgage by yourself, got to pay the real estate taxes, you got to pay all the expenses and water bills and things like that while you turn that unit over, while you market it. And you could be looking at a month or two worth of vacancy of eating all those expenses while you put a tenant in, and then you go back into the black, right? So I've always been a multifamily guy for that reason. I read some books by a guy named Dolph DeRoos, and I've read a ton of other multifamily, books over the years that really expose that long-term wealth is in multifamily, because it's just the stability, and because it's not subject to the single-family home market like a single-family home is. Meaning, home buyer, the sale of single-family homes to home buyers can, if you're in the right neighborhood, affect the value up or down of your single-family home rental. Other factors affect the value of multifamily, so it's not as the swings aren't as wide on multifamily as they are on single-family homes. So I've always been a multifamily guy, to answer your question, but we started a lot smaller. We sold our property in Philly and did a 1031 exchange. If your folks are, it's just you take all the proceeds from the sale of this of one rental property, and you use those proceeds to buy the next one, and you don't have to pay any capital gains tax on it, which is it's a longer conversation on the nuts and bolts of that. But in essence, it's a way to defer capital gains tax on the sale of rental property. So we bought 2 4-families in Ewing, New Jersey, and slowly started buying other 4-families on the block that they were on. We bought one across the street. We bought two across the street from that one, and before you knew it, well, not before you knew it, over like a period of 4 years, we had assembled, right, not blink of an eye, all of a sudden we got 20 units. No, it took 4 years, right? It took 4 years to assemble 20 units on this block. And in essence, we treated it on our books, and we were able to sell it actually as a 20-unit apartment complex, even though it actually wasn't. It was actually 5 4-family homes. So that's how we grew into multi, and that's a big advice for your folks out there is you don't have to go out and buy 20 units all at once. You can buy smaller multi if they're in a geography where there's a bunch of them in one area. What was great about these buildings is you buy one of them. If you walk through one of these buildings, you've seen all of them, because they were built as 4-family units. I prefer built as multifamily versus conversions, like the old Victorian that's been converted into and it's been chopped up into 3 to 4 units or something like that. I really don't like buildings like that. I prefer buildings that are built as they were built for that intention, to be a multifamily property. So these buildings were built like that. And so my maintenance guy, my marketing folks, me and anybody that worked for me or got to know these buildings, got to know them very easily because they were all the same. And it was very easy to market them that way. So my advice to your listener base would be if you're just getting started and you want to get into bigger multifamily, you don't have to go out and buy this enormous apartment complex. Buy one unit on a block of a bunch of them and get to know the other owners, and slowly you can start absorption of the other properties on the block, and that portfolio will start to behave as a multifamily apartment complex, even though they're on separate tax parcels.
So what are they looking like today? I mean, what are the deals you're working on currently? Because I think you've gone into another direction, right?
Yeah, well, that's the thing. Like I said, we just put a duplex under contract last week, but yet I went and looked at a 52 unit outside of Philadelphia last week. There's other stuff out there that we're looking at that we may be putting under contract as well. So we haven't gotten into this yet. Over the years, since 2010, we started raising private money, and my first private money deal was 2 little single family homes. A guy put in $50,000, and we did 2 single family home deals with it. We've since expanded from there to, we're raising more and more private capital. And so I've got a a line of investors that I have really good relationship with that are relying on me to find more opportunities for them to get into. So we're now looking at, between 50 and 100 unit apartment complexes to buy assembling private equity and, doing a limited partnership that these folks have a direct ownership in, and, closing on these properties and cash flowing them long term and, sending our investors a check once a quarter.
So your strategy is to find something that's relatively stable as opposed to something that would need a large amount of construction?
Yeah, you know what? Here's what I like. I like the occupied building that needs to get repositioned. That's maybe, you hear this thrown around all the time, but the property is in a C-class neighborhood, is in a B-class neighborhood, but is a C-class property, meaning it's a step below the neighborhood that it's in. And so through adding amenities, raising rents, perhaps separating utilities, stabilizing the property, we can bring it up to the condition of the neighborhood that it's in. I'm not looking for the vacant 40-unit building at this point anyway. Maybe where we need to go as the economy changes, but I'm not looking right now for the vacant 40-unit building that needs a full gut renovation. I know guys that are doing it. There's a possibility to do well with it. There's a possibility to get your teeth kicked into, but I prefer properties that need to get tweaked, adjusted, better maintenance strategies, better marketing strategies to increase value. So the buildings we've been looking at are at least 75% occupied or more. So, and the reason for that, if I may, Dan, is that I like cash flowing assets. I'm a dividend guy. If I were a stock guy, which I have been, I do own stocks now, I prefer dividend yielding stocks because I like things that produce cash on a regular basis. And that I know they're more boring and they're not exciting like Google that are going to go up and down and make you lots and lots of money on a short-term basis and make you a millionaire overnight. But I'm not that kind of an investor. I'm a slightly boring, dividend yielding, produce me a check once a quarter kind of thing. And that's the kind of real estate I get into, is dividend yielding real estate that has cash flow that I can juice and then tweak over the years to increase that cash flow.
Cool. So I'm going to shift gears once again here, and I know we want to touch on the private money conversation a little bit. So here's one of the challenges I'm running into right now. I've been in the business 10 years and, bought and fixed up and sold a number of properties. I've done a lot of wholesaling over my career. That's how I primarily found my opportunities, was by making sure that I, position properties that aren't maybe necessarily in the neighborhoods where my lenders and where my contractors want to go, either for geography or price point or for whatever other reason they're not willing to close in certain areas. I've wholesaled those properties out and fed my marketing machine to keep the opportunities coming in the door. But also, I've done deals, as you've probably done deals, where even right now, we're going to settlement in end of February, and we have to write a check for $8,000 to $9,000 to clear our private lenders. We're losing money on the flip is where I'm going with it. So I've also gotten to the point, Matt, where I'm now much more picky, and I feel like I'm having this challenge, and maybe you could relate, and maybe you're dealing with the same challenge. We have, $1.3 million floating at any given time, private money, but we don't have all that money put in place. So these investors are looking at me to find more properties, and I have to place their money into properties that are going to be profitable. So it's been a little bit of a challenge to keep the money working for us. And we've had to have that money sit on the sidelines in our investors' coffers as opposed to ours. And I'm curious where I'm going in a direction, with this example is you talked about, I know I read it somewhere, it was the $8 million in private money, and you have this long line of investors, and I'm not sure what the number is that it adds up today, but what percentage of your investors' private money do you have working at any given time? And do you have any suggestions for kind of helping keep the investors on the table? Or are you also just like I am, kind of racing against the clock a little bit, and sometimes I go to a private investor and he had already placed the money into some other thing? So can you just kind of maybe talk about if you're facing that challenge and also how you would deal with it?
Sure. It's a great question. A couple different things. Number one, there's the private lenders are folks that I use that are in short-term stuff. This may be what you're referring to, where they're getting in at 4,
Correct.
5, 6, 9 month deals, right? I got a buddy of mine who does the same, all us real estate investor guys that have been around for a little bit and have a few battle scars all tend to know each other. So I got another real estate investor friend of mine who is doing what I'm doing. Although he doesn't do private equity, all he does is private loans. And when he frees up his capital, like you're talking about, he continues to pay him interest. Like he just keeps their money in escrow and makes interest payments on them. Now you talk about lighting a fire under yourself, right? I tell him he's out of his mind for doing that. I'm like, you're crazy. That's just gonna, like, you're paying for money you can't use or you're not using. It's just sitting there waiting for you to use. But I can tell you nobody works harder than this guy. He's constantly running around finding new opportunities to get himself into with that money. So it tends to burn a hole in his pocket, and it's kind of like a motivator to keep him moving. I'm not jealous of that scenario, and that's something I would want to do. But that's one way that you could do it, is to hold investors' money and pay them. It's not something he does, but I would do this if I were to do what he's doing. Pay him a reduced interest rate for while the money's not applied. While the money's sitting in escrow waiting for the next deal. And you can even keep it in escrow in a really, really safe neutral party place, either your title company's escrow account or your attorney's escrow account, whatever it may be, and pay them, I don't know, I'll make this up, like half of what their normal rate of return is on their money. That's option one. For me, for my private lender guys, I do have a rate that I pay that's a very, very reduced rate if the money gets rolled over very quickly. And if the money has to season for a while, then he gets a better rate on his money. You know what I'm saying? He gets a higher interest rate if he has to wait for a month or two for me to replace the funds. And so there's been a few times where I closed on a Monday on a sale that exited him from the deal. And by the time that the money cleared with his self-directed IRA, I already had, he was already sending wiring instructions for the next deal. So I tend to fill my pipeline to the point where I can keep paying that lower rate, if that makes sense. So that's the second piece of advice, is you just keep an eye on your pipeline if you can. And then I would kind of push closing a bit if I have to, that kind of thing. If closing on a sale is going to delay a while, or a refinance or whatever it may be that gets his money out, I may push the next thing so that I can, think about where I can stagger them a little bit. And the third thing, I do a lot of private equity, and private equity stuff tends to be a way, way longer investment. So I don't have as much of that problem for a lot of my bigger money. A lot of my bigger money is in private placement, private equity deals, apartment buildings, that kind of stuff. These are not private loan guys. They don't have a debt position. They have they have a direct ownership of the building. They get a K-1 at the end of the year for their ownership of the LP that owns the property. They own a chunk of the dirt themselves. That being said, they're into the deal for years. They're into this deal for probably 5 to 7 years, and they understand that's the life of their investment. So I don't have to worry as much about where am I going to put them, because they know that this is just an alternative investment on their part, and they get a check once a quarter basis the performance of the building. But the private lenders are, I said I'd said before how to maintain that stuff. So and here's the last thing I'll tell you. Okay, because I actually, it's funny you're bringing this up, because I'm in the same boat, my friend. I have a private equity fund that I raised, and we have a sizable amount of money, a couple $100,000 that's just sitting there in the checking account that I'm having a problem placing. And so it's not paying interest. It's just the investors aren't making the dividends they want to make quite yet. I guess compliment I would pay myself for the reason why it's still sitting there is we ended up exiting from 2 deals that I was going to get into with that money. I was worried. My spidey senses started tingling. There's things that showed up during due diligence that really concerned me as an investor. And so the other thing I would tell any investor that's starting to push me about, where's my return? This is on the equity side, is to say, listen, my job as the general partner of this fund is to put you into places where your equity can be preserved, number one, and can grow. And so I didn't see that those two things were going to happen on this investment. I was concerned about the risk on this deal, and so I exited us. I got us out of the deal, and it's only so that I can at least preserve your capital as your general partner. And so although they're not getting their nice fat dividend check, I would hope that they would rest assured knowing that it's in good hands, and I'm not going to put them at risk or put their money into a project just for the sake of putting their money into a project. because I tend to be very finicky on what I put my guys into. Number one, because it's not my money, it's their money. And I really take seriously the fact that you and I are custodians of these people's wealth. And I get to make money off of being a custodian of their wealth just as you do. But I try and remind them of that. Like, listen, my job's not to give you the highest, I do want to give you the highest return that I can, but first and foremost, I want your money to be in a safe place and not a deal that could have a problem. And I smelled that on those two deals, and that's why I backed out. So those are 4 tips on what I would do in your scenario.
Cool. Appreciate that. Well said. Do you have any insight, suggestion, or maybe you could share an example of like maybe how you've come across the path and met a few of your investors and private lenders? Do you have some system for attracting people?
Well,
to invest?
It's not, well, here's the thing. I tend to believe, but yeah, and I'll gladly tell you a few stories on how I met some of these guys, but and girls, by the way, because it's not just guys. But the folks that invest with me, I've met through a couple of different walks, and like I said, I'll gladly share that. But first and foremost, this goes out to your audience too. You don't need to be like a member of a country club or learn how to play golf or something like that to raise private investors. It's not like all the folks that have money to invest with you all hang out in some echelon that you're not in, and you need to have a silver spoon in your mouth to be, born into this, to be able to do what we do. I say this with confidence, and people may not know this is true, but it's true. Everyone knows people with money. They do. Everyone knows people with money to invest in real estate. And I think that when you learn where to start looking for money to invest in real estate, then you can start to find that those outlets are out there. What I'll do, Dan, is I'll forward you for your show notes. I'll forward you an article that I wrote that's about the 3 places to look for money that your audience base can read afterwards. But I'll forward that to you as well, so we can, maybe have a conversation offline about it or whatever it is. But that's the bottom line: is everybody knows people with money, and the way that you start uncovering those people is, number one, by talking about what you do with everyone, whether that's at a networking event or your immediate family members or your friends or whatever it is. I invest in real estate, and I'm helping people, build their wealth through alternative investments, because the folks that are building their wealth through the stock market right now can't rely on it. Just who knows what the stock market's going to do tomorrow? It's up, it's down because, oil's down, or because China decided that they were unhappy about something. And so these people's long-term wealth is getting jerked all around the place. And so it's time for folks like you and I to really come forward and say, we offer an alternative place for people to make money. Here it is. And so I think you're going to see a lot of changes in the world, by the way, on people's ability to invest in what you and I are up to. But that's a side note. So first and foremost, the people that I've met, my private lenders, are either people that are friends and family that immediately trust me. Those were my first round of folks. Or people that I've just met. There's a guy that runs a restaurant in the neighborhood of my office that, I would go in and frequent and, go in and have lunch or something like that. And I get to talking to the owner about what he's up to, how his weekend was. And before you know it, I got into business. And now this guy that owns this restaurant has several $100,000 invested with us, just because I got to talking to him about what we do. And as you know, this to you, Dan, but also to your other folks that are listening to this, what we do is cool. It's an interesting conversation. It's not like, oh yeah, you're XYZ. That's great. Change the subject. It's, wow, you invest in real estate. What's that like? How'd you do with the market? How's this? How's that? What kind of real estate investing do you do? Are you like those guys on the TV flipping that house? There's so. I rarely do people change the subject when I tell them what I do. It turns into a conversation. And so if you weave in the fact that you work with folks that have private equity, that have some skin in and get to win alongside you in this business, I find that it's very rare that people that have money don't want to put it in. A whole other conversation that comes up in the article that I'll send you is sometimes people don't know they have money. And these are people that have things like self-directed IRAs, or even just an IRA, a retirement account. People don't realize that can be utilized very easily and very lucratively in real estate. Also, people that have very little mortgage on their home or own real estate free and clear, they can get into the game, and obviously people that have a lot of cash know that they can get into this game too. So they may not know. And so you might need to learn the tools for sniffing these folks out, which I go over in the article. So, and the stories, the guy that owns a restaurant, and then my wife was at a networking event for an alumni for her college. and she just was talking to one of her friends from college. And the guy ended up working, he's a wealth manager for a large financial house up in New York. And he said, I'd love to invest in real estate, but I don't have the time. Ding, like ring the little bell right there. That's the idea bell. Anytime you hear somebody say that, guys, that is a huge, huge opportunity for you to convert someone into a partner in your business, because who does have the time? I got the time. You got the time, and your listeners probably have the time to put money into great real estate opportunities. This guy that she was talking to was working like 70 hours a week as a wealth manager and did very, very well for himself, but only knew one way to make money, through the stock market. And so I was able to, through several meetings with him and lunches and, boots on the ground coming to visit us in here in Trenton, saw the possibility of him investing through us in our business. And very quickly, got very comfortable with what we were up to. And he's become one of our best investors and also has referred us a ton of other investors for our business too. And so that's the next thing is that, we have gotten a bunch of investors through referrals, because if people are okay with it, we will pay them in equity for referring us to another investor. So if investor A is invested in the fund and investor B is a friend of theirs or their brother-in-law or whatever that invests in the fund too, I'll give investor A a couple of % extra ownership, and I'm allowed to do that as a general partner. I'll throw him a couple of % ownership, and it's all it's all disclosed, right? But I'll give him a few points of ownership for turning over that lead for investor B. So those are a couple of different ways that I generate private lenders and private investors.
Cool. A ton of powerful content there. So do you have 3 book recommendations you could give our listeners, maybe based on some of the stuff we had talked about here, Matt?
Sure. Well, okay, there's the basics. I'm sure probably every guest you have on your show talks about Rich Dad Poor Dad, but I have to throw it out there that it's such a basic, fundamental book of just alternative ways to make money, and realizing that it's okay to have a job and that kind of thing, but understand that it may not be your long-term way to wealth. So that's number 1. Number 2, and we didn't even talk about this because we just didn't have the time to get to it, but I think that overcoming your fear around money and really repositioning the way that you view money in your life is something that's an absolute key to be able to do this, because if you don't see the value in what you do, so are other people. They're going to see that too in the way that you come across. So if you're going to start pitching potential investors or potential private lenders and you don't see the value in yourself or in your money or in money and it's in your ability to raise money or in the projects you're going to find, you're not going to get very far. And so the answer to that, like the book that I found that really shifted that, is a book called The Secrets of the Millionaire Mind, T. Harv Eker. So that's another one that I recommend. Now, number 3, so many out there. There's The ABCs of Real Estate Investing by Ken McElroy, which is a property management book. And I'll throw another one out there. I'm reading it right now, and I'm really enjoying it. So I'm going to one-up you and go for 4. It's a book called The Soul of Money, which is a fantastic book about paying it forward and about, once you make all this money in real estate or whatever it is you do, what do you do with it? How do you, money, I believe, according to this book as well, is money has a footprint, a fingerprint associated with it, and it can do good or bad. And so it's about utilizing money and viewing it as something having a soul and moving it into its greater good. So that's a good book as well. So
interesting. So do you have any final jewels of wisdom you'd like to share with our listeners, Matt?
Yeah, man, I say this I'm doing a speaking thing this weekend, and I've already written my script for that, so I have this as my close on that too, and I'll probably close a lot of my talks and radio shows on this. There are 3 things that will stunt your growth or stop you from moving forward in this business, from being successful in this business. If you avoid these 3 things, then you have no choice but to be successful. It's just what's going to happen. The first thing is quitting, right? So when the time gets tough, quitting. And there's so many times that I wanted to quit, but I didn't. And so I think that you find that if you just move forward and find the next route and not, had I given my office building back to the bank and said, you know what, screw this, the economy changed, guys, here, take it. Here's a deed in lieu of foreclosure, bye-bye. Then we would have missed out on a great opportunity. And you got to realize the economy changes, time changes, the market changes, neighborhoods change, that kind of thing. So I think quitting in this business is the number thing that'll it's the obvious one. That's the obvious thing that's going to shut you down. The second thing is getting stalled out. You got to take action in this business. And so if you don't take action, you're not going to move forward. If I told you, hey, Dan, listen, you and I are going to drive from my office here in Trenton and we're going to go to San Diego, but we're not going to leave until all the stoplights that exist between here and San Diego turn green. Right. We'd be sitting in Trenton for a very, very long time, right? So that you are going, if you get stuck about worrying about that stoplight that's down a couple miles down the road, you're never going to move. But what you realize is you mitigate challenges. You work your way around things. And so paralysis by analysis and not putting one foot in front of the other is another potential to getting stalled out and losing a lot of time in this business. So you have to take action. That's the second thing. Don't quit and take action. And the third thing, and this is a hard one for all of us, I think, is don't let your emotions get involved, on either side, whether that's getting too excited about a deal and jumping in. Like the place that I have done this way too many times is that real estate auctions. Bidding. I don't know if have you ever gone to a real estate auction?
I don't do auctions. They're the worst way, in my opinion, to overpay for a property. So
absolutely,
I just avoid them.
it's a contest to see who's willing to make the least amount of money. Is what an auction is, I think.
True enough.
But hey, yeah, right. But not letting your emotions get involved on the good side, which is what happens in an auction where it's like, I'll take it. It's so exciting. It's a great deal, and throwing lots of money down, or thinking things like, oh, I can't lose, or the market's going to continue to go up, or whatever it is. Or on the other side, about getting adversarial with people, about getting negative or getting downtrodden or whatever it may be in this business, and not letting your emotions get involved in the negative side as well. So either way, you got to, as best you can. We're humans. We have emotions. They don't go away. They're still there. But I think that not acting from emotion and just not letting them control your decisions in this business is the last thing to success. So to sum it all up, like I said, don't quit, take action, and don't let your emotions get involved. Those are my 3 tips that I would give any real estate investor in this business.
Nice, Matt. Do you have some contact information, URL, or some other way listeners could get in touch with you or find out more information about you?
Sure. DeRosaGroup.com is our website. You can reach me at mfaircloth@DeRosaGroup.com. That's my email address. I'm all over the local marketplace here in Philadelphia and South Jersey through R.E.I. I run a R.E.I. in Princeton. If folks want to come see me in person, up there we meet on the 3rd Thursday of the month. So come see us up in Princeton, and I'm going to drag you up there too, Dan, to come visit us and return the favor of letting me grace your podcast here. This has been fantastic, and so I'd like to have you up to visit us too, as a plug for you coming to our podcast, to our R.E.I. at some point, so your listeners can come up and visit us.
Appreciate that. I'll make sure we get that on the schedule. I've got a record-breaking number of pages of notes I've taken on this episode. I thank you for a ton of great content and wisdom, and thank you for coming on the show.
That's a nice way of telling me I talk too much, isn't it?
No, absolutely not.
No, I'm kidding. This has been a great honor. Thank you so much. I've really enjoyed this, and I hope it added value for your listeners.
Absolutely. And to our listeners, thank you for continuing to tune in to the R.E.I. Diamond Show. Do you know anybody else who might enjoy this episode? Send them a link. You can also sign up to receive new episode notifications at www.reidiamonds.com. And as a bonus for signing up there, I'll send you my special report titled 7 Sources of Off-Market Deals. There's also a public relations link on that page for those interested in applying to come on the show as an expert guest. The website again is www.reidiamonds.com. Thanks again for listening. Dan Breslin here. I'll catch you next time. And remember, here at the R.E.I. Diamond Show, we're dedicated to increasing, multiplying, and protecting your net worth.
Thanks for listening to the R.E.I. Diamond Interview. To receive the R.E.I. Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.